Hi, everybody, and welcome back to video number 5 in chapter 16. And when we left off, we were looking at the equity method of accounting and the Borden and Mylar examples. Now, when we compare the fair value method and the equity method, let's take a look at this. Here we have the fair value, and over on the right side, the equity method. So on January 2nd, Maxi Company acquires 48,000 shares. That's 20% of many companies' common stock at a cost of $10 a share. So here we can see that we have debited equity investments and credited cash for that $480,000. For the year 2025, many company reports net income of $200,000. So Maxi's share of that, 20% of $200,000, is going to be $40,000. So under the equity method, we're going to record a debit to equity investments and a credit to investment income. Whereas under the fair value method, we did not make any journal entry for that. Now at the end of the year, December 31, 2025, the 48,000 shares of mini company have a fair value at market price of $12 a share, or $576,000. So that difference between $480,000 and $576,000 is $96,000. So under the fair value method, we debit the fair value adjustment. Unrealized holding gain or loss is credited, that's dash income, for $96,000. And no entry is required under the equity method. Now, at January 28th, 2026, Mini Company announces and pays a cash dividend of $100,000, and Maxi Company receives 20% of that, or $20,000. So, under the fair value method, we debit cash and credit dividend revenue for $20,000. But under the equity method, we debit cash, but the credit is to equity investments. Then for the year 2026, Mini reported a net loss of $50,000, and Maxi Company's share is 20% of that, or $10,000. Under the fair value method, we wouldn't have an entry, but under the equity method, we're going to record that $10,000 as a debit to investment loss and a credit to equity investments. Then, at December 31, 2026, Mini Company's 48,000 shares have a fair value of $11 a share, or $528,000. So we're going to take, under the fair value method, we're going to debit the unrealized holding gain and loss and credit fair value adjustment for $48,000. Okay. I think that's clear, and we'll move on from there. All right, now, if we hold more than 50%, we're going to use consolidation method. And that means that we have controlling interest, more than 50%. One corporation, the parent, acquires the voting interest of more than 50% of another corporation, the subsidiary. So under bullet point 1, the investor corporation is referred to as the parent. The investee corporation is referred to as a subsidiary. And bullet point 3, investment in the subsidiary is reported on the parent's balance sheet as a long-term investment. And bullet point number 4, the parent generally prepares consolidated financial statements. Okay, let's see how that looks. Here, the Acctg company acquired 30% of the outstanding common stock of II-Chapt Incorporated on December 31, 2025. The purchase price was $2,400,000 for 100,000 shares. II-Chapt declared and paid a $4 per share cash dividend on June 30th and December 31st, 2026. II-Chapt reported net income of $1,460,000 for 2026. The fair value of II-Chapt's stock was $27 per share at December 31, 2026. All right, so we have instructions here. Alpha, we want to prepare the journal entries for Acctg for 2025 and 2026, assuming that Acctg cannot exercise significant influence over II-Chapt. So if I jump ahead, our journal entries are going to look like this. On December 31st, 2025, we'll debit equity investment for $2,400,000, credit cash to pay for it. Then on June 30th, we get 30% of that $400,000 cash dividend. So we'll debit cash for $120,000, credit dividend revenue for $120,000. Do the same thing at December 31st, but we also make a fair value adjustment of $300,000. And the credit is going to be to the unrealized holding gain or loss dash income. And we get that number, $300,000, by taking $27 fair value times 100,000, that's $2,700,000, and then we subtract out what we paid, $2,400,000, and that's going to be a $300,000 difference. Okay, now if I go back to Bravo here, we're going to prepare the journal entries for Acctg for 2025 and 26, this time assuming that Acctg can exercise significant influence over II-Chapt. Now, if we do that, then we're going to have equity investments in II-Chapt Incorporated at $2,400,000. We'll credit cash. You'll see that's very similar. And then on June 30th, we're going to have a debit to cash and a credit to equity investments of $120,000. Same thing that we did December 31st. And the equity investments in II-Chapt is going to be 30% of the $1,460,000, which was given here in the problem for II-Chapt's reported net income for 2026. All right. So we'll debit equity investments for $438,000 and credit investment income for $438,000. Now, under Charlie, at what amount are the investment in securities reported on the balance sheet under each of these methods at December 31st, 2026? What is the total income reported in 2026 under each of these methods? Okay, so, here, under the fair value method, the investment account is going to have a $2,700,000, and that's going to be the $2,400,000 plus the $300,000 that we did earlier. Then, under the equity method, we're going to have the $2,400,000, but we're going to add this $438,000 less the 120,000 and less 120,000. That'll get us to 2,598,000. So dividend revenue using the fair value method is going to be $240,000, and that's 120,000 times 2. And then the unrealized holding gain, which we calculated earlier, income statement account, 300,000. Total income, $540,000. Whereas under the equity method, we don't record the dividend revenue, we don't record the unrealized holding gain, but we do recognize the investment income of $438,000, which we have here. Okay, a little tricky. I think with a little study, you'll remember that and understand it. Okay, now we're going to evaluate other major issues related to investments in debt and equity securities. Here, under the fair value option, companies have the option to report most financial instruments at fair value, with all gains and losses related to changes in fair value reported in income. Under bullet point number 1 here, we're going to apply that on an instrument by instrument basis. And then under bullet point 2, where it's generally available only at time a company first purchases a financial asset or incurs a financial liability. And under bullet point 3, the company must measure this instrument at fair value until the company no longer has ownership. Okay, so here the Hardy Company purchases bonds in Fielder Company during 2025, which cost $100,000, and classified them as available for sale. On December 31st, 2025, the fair value of these securities is $125,000. How should Hardy record this transaction if it chooses to use the fair value option? If they choose the fair value option, it's going to make the following entry at the end of 2025. Debit to debt interest, debit to debt investments, $25,000, the difference between $125,000 and $100,000, and a credit to unrealized holding gain or loss dash income for $25,000. In that situation, Hardy uses the debt investment account to record the change in fair value at December 31st. It does not use the fair value adjustment account because the accounting for a fair value option is on an investment by investment basis rather than on a portfolio basis. Okay, now under the equity method, Durham Company holds a 28% stake in Supan Incorporated. Durham purchased the investment in 2025 for $930,000. At December 31st, 2025, the fair value of the investment was $900,000. So Durham elects to report the investment in Supan using the fair value option. So what entry should it make? And the difference again was $30,000. So we'll debit unrealized holding gain or loss income for $30,000 and credit equity investments for $30,000. In contrast to the equity method, if the fair value option is chosen, Durham does not report its pro rata share of the income or loss from Supan. In addition, any dividend payments are credited to dividend revenue and therefore do not reduce equity investment accounts. That looks like a good place to stop this video. And when we return, we will take a look at a note receivable example. Until that time, bye for now.